All right. Okay, good morning, everybody. Welcome to today's second session where we're going to explore environmental markets beyond carbon. I'm Brian Fellin, Senior Vice President of Xpansiv's Registry and Power Infrastructure Divisions. It's an honor here to be with all of you, our panelists, as well as all of our guests in the room. And we all share a passion for using market-based mechanisms to accelerate environmental stewardship. We'll spend some time in this session examining the diverse landscape of environmental commodities beyond carbon, which also really allow us to assign economic value to the responsible production and usage of electricity, fuels, and plastics. In today's conversation, we're also going to explore the current state of these markets, the challenges and opportunities they present, and also their potential to scale sustainable outcomes while fostering economic growth. We have a great lineup of panelists here today, each with unique insights into the complex and evolving space. They'll share their perspectives on the role these markets are playing globally, what innovations are on the horizon, and how policy, regulation, and demand-side interests are shaping this landscape. So without further ado, we'll get started by introducing our speakers. To my left is Robin Ricks, Chief Policy and Markets Officer at Verra. In his role, Robin leads Verra's work to ensure responsible use of Verra's programs and standards. He leads teams responsible for policy development, government relations, stakeholder engagement, market development, and legal affairs. Prior to joining Verra, Robin worked as a lawyer at Clifford Chance in London, the United Nations Framework Convention on Climate Change, or the UNFCCC, in Bonn, and held roles with the province of Ontario and Government of Canada. To his left is Yuhao Lin, Vice President, Environmental Commodities at Morgan Stanley. Yuhao has been trading, originating, and structuring environmental commodities transactions since 2009. He got his start in the market at Noble Group, originating voluntary carbon offsets with the potential to be accepted into the California cap and trade compliance market, and the then proposed U.S. federal cap and trade program. From there, he went to NRG, where he traded compliance and voluntary markets in carbon, renewable energy credits, NOx and SOx, as well as various regional ERC products around the U.S. In late 2020, Yuhao joined the Morgan Stanley Power and Gas Trading Desk in New York, where he has led the effort to build out and expand the firm's capabilities and product offerings in all things environmental commodities. And to the far right is Kyle Harrison, Head of Sustainability Research at Bloomberg New Energy Finance. Kyle leads BNEF's Sustainability Research Team, which publishes content on the private sector's transition to the low-carbon economy. The team focuses on core areas like environmental, social, and governance reporting, target setting, corporate decarbonization pathways, and sustainable finance. Kyle specializes in corporate clean energy procurement and the voluntary carbon market. So thank you all for being here again. We're going to give each of our panelists a moment to kind of set the stage, share some context of their respective roles and organizations, and we'll start with an overview hearing by each of you, beginning with Kyle, how the renewable energy credits, plastic credits, fuels, and biodiversity credits function within their respective markets, along with some of the most significant trends that are developing.
Perfect.
So, Kyle, if you lead us, please.
Yeah, excellent. Thanks, Brian, and also thanks to the Xpansiv team for having BNF here today. So yeah, Brian, like you mentioned, at Bloomberg NEF, the way I like to describe the sustainability team is that we are looking at the private sector's role in leading the low-carbon transition. So a lot of other BNF teams write about the uptake in electric vehicles, the uptake in clean energy procurement, and then regional power markets, for example, and carbon markets. We kind of flip that on its head and we say, what role can a corporation or a financial institution play in helping the growth of those markets? So that's really the perspective that hopefully I can bring on the panel today. And Brian, like you mentioned, right, outside of carbon, which I know is the focus of a lot of our discussions today, there's a whole other slew of environmental markets out there. And some of them are more mature, right? You can talk about, for example, compliance renewable energy certificate markets. But some of them are also far more nascent, right? When we go into biodiversity credits and you talk about measurability challenges, that's a far smaller market with a lot of potential to grow, but we have a lot of work to do there. But I think the common denominator, there's a few common denominators between all of these markets. Some of them are more positive, some of them are more negative, and I think we'll talk about all of these today. But I think on the positive side, right, what these markets do, if they're effective, is they'll allow a company, again, coming from the corporate sustainability perspective, to neutralize their impact somewhere along their value chain, oftentimes at a cheaper cost or price to what they can do within their own mitigation efforts. but also at a much larger scale. And that's been a really big benefit, for example, when you think about renewable energy certificate markets. The challenge, though, that comes kind of hand in hand with that scale is this term additionality or impact, right? We hear it a lot in the voluntary carbon market, but people were talking about it far earlier in the renewable energy certificate market. How do I know that if I'm investing into, for example, renewable energy certificates, that I'm having the same impact as a company that's going out and signing a power purchase agreement, right? And so there's still a lot of kinks to work out in these markets, but at their best, they're a really effective way of channeling finance to getting the private sector to engage in some of these low carbon mitigation efforts.
Perfect, perfect. And you, Hal, as a trader at Morgan Stanley, you've covered a diverse range of commodities throughout your career. When you think about non-carbon environmental commodities, what immediately comes to mind, and how do you see your role at Morgan Stanley wrapped around that?
Yeah, thanks for the opportunity. Thanks for having me here. Happy to kind of touch on that. I guess big picture, what we're trying to do at the bank in this market is ultimately, like our view is that these markets, much like any other market, like at the end of the day, the solutions are similar in terms of how do you get capital into the market, how do you get projects producing, how do you get buyers what they want. The solutions in terms of, transparency, efficiency of transactions, right, price discovery, risk assessments, all that, are going to be similar. It's the pathways to those solutions that require adaptation to the market's idiosyncrasies. And within this market, there are so many different products, and each product has its own kind of character and personality almost. So that's the challenge for us, and that's why we kind of staffed up in terms of in any market we have, generally speaking, we go kind of into the market to kind of search for people who have the expertise, whether it's metals, power, gas, whatever it is. So we're essentially trying to match make, and we're trying to make sure that the entire life cycle, that people kind of play their sort of helpful role and natural role in the life cycle of these products. With respect to, I would say, I'll take two examples of what you laid out. In renewable energy credits, to Kyle's point, it's been around for a long time. And it's probably the longest standing in terms of the most mature environmental commodities market. So it comes into this space, it comes into this next evolution, next stage of development with that experience in mind. And it has a lot of, I would say, it has the advantages of a buyer base, a demand side that is comfortable with the product, to some extent. But it is evolving in terms of additionality and how to define those things. Something like sustainable aviation fuels is exactly the opposite. We know it's additional because it's not around, right? But how do you get people comfortable with the product? How do you actually structure the market in a way that, in a way that you're sort of determining the standards as we move forward? And so there's a different type of risk that you're looking at in terms of execution and structuring and all that. So they kind of come at it from different ends of the scale. But again, our strong view is that the solutions ultimately are going to be the same. Investors are going to play their role, buyers are going to play their role, third parties rating risk, lenders, right? Different levels of the capital structure are going to have to be defined and put together. And most importantly, I think, if there's one takeaway from this talk that I want to kind of try to put out there is that there's risk everywhere, right? Everyone's going to have to be comfortable with the risk that they're going to be left with. There is no final answer. There's no way to wash away greenwashing risk, right? There's no way to wash away market risk or performance risk and all that.
Beautiful, beautiful. And coming back to Robin now. So Robin, if you don't mind maybe spending a few minutes talking about the plastics program at Vera, right? It's more of a nascent program relative to, as you mentioned, renewable energy credits or carbon offsets. But if you could speak to that a little bit and just share, how that came to be and where it's going next.
Absolutely, and thank you very much. It's great to be here. So Vera was founded in 2007 on the basic principle that it's possible to quantify the impacts of interventions, of actions of environmental or social actions. And it's possible to have those impacts quantified and then made available for a variety of different uses. We're best known, I think, for our carbon crediting program, of course. But that being said, I think as the years went by, we recognized that the principles that underlie carbon crediting, that concept of quantifying emission reductions and removals and making them available for downstream uses, had broader applicability. And when we look around at the challenges that the world faces, the problem of plastic pollution is, of course, right up there. It dominates a lot of UN environmental program discussions right now, whether it's treaty negotiations or otherwise. Certainly many countries are taking notice. And we sort of wanted to get into that area. And so we developed and in 2021 launched the plastic program at Verra. And it operates broadly on similar principles as the carbon crediting program does, in the sense that there is a very transparent way in which projects get brought forward, listed, they then get third-party validated, they are then registered, all the information is available on our website, and then they undergo sort of a cycle of verification, followed, if they are successful in all of that, through the issuance of plastic credits. After a slow start, we have about 17 projects registered right now, with about another 45 or so in the pipeline that are currently at various stages of development. And we've issued around 11,500 tons 11,500 credits, each representing 1 metric ton of plastic waste. I think what makes plastic credits as interesting as it is, at least for me, is that we have two methodologies. One's for collection and one's for recycling. And both of those are very analogous to removals. I think when you look at carbon right now, there's this big reduction versus removal debate. No doubt you've seen the headlines in The Guardian and all this other stuff about a lot of concerns. And a lot of them do seem to match up to this reductions in the sense that we are looking at, we're comparing to a hypothetical counterfactual baseline. And obviously that's very inherently difficult to measure. With plastics, the best analogy I can do is that it is a form of removal. It's collection and it's recycling. We don't actually have a sort of a reduction methodology per se. And I think as we heard in the first panel today, removals do have a lot of potential in the carbon space, and we're absolutely seeing that right now within the plastics space. And so we are seeing, I mean, we're very much on the supply side. I can't, my colleagues are better placed than me to sort of provide indications of the buy side, the demand, where that's coming from. But based on everything that we've been seeing, whether it's the UNEP treaty negotiations, whether it's EPR schemes around the world, or whether it's just frankly an increasing corporate interest in tackling plastic waste within their supply chain, we're trying to position ourselves at Verra to support all those different use cases and for what we anticipate to be a growing market in the future.
I think that's incredibly important, and there's a number of key themes, Robin, as you mentioned, covered in the last panel, particularly about carbon capture. Also, we were talking about risk and managing that risk through OCA and some of their insurance products. And it's very similar to when you think back on the progression of renewables, right? And I'll admit, as an oil and gas engineer coming into the power space, I was initially very skeptical of renewables and whether or not they would ever find their own economic freedom, where the cost curve came down so much, the levelized cost of energy came down so much that these are self-sustaining investments in many respects. And when we think about plastics, when we think about sustainable aviation fuel, biodiversity credits, right, they're more nascent in terms of their evolution, but may follow a similar path perhaps that we've seen play out with renewable energy. So maybe pointing to Kyle and Robin, and of course you, Hal, weigh in. When we think about these alternative environmental commodities, how can businesses use renewable energy credits, plastics, and other types of environmental commodities to meet their sustainability goals, but then also perhaps even create competitive advantages?
Sure. Yeah. So when it comes to purchasing environmental commodities, when you think about, for example, a renewable energy certificate, whether that is unbundled, right, you're just purely buying the certificate, or it's bundled with power through, for example, a power purchase agreement, you can use those certificates, each pertaining to a megawatt hour of clean electricity production, in order to offset, in most cases, your Scope 2 emissions, which come from your indirect purchase of grid electricity. You can apply a very similar logic to carbon credits, for example, to neutralize your Scope 3 emissions, or, for example, plastic credits to neutralize your plastic waste. And companies can go out and again, they can buy these at a large scale in order to make environmental claims. This again raises questions around impact, right? I think we'll talk about this a little bit later on, I'm sure, but for example, when you think about renewable energy certificate markets, this is very geographically specific, right? And when you think about the evolution, for example, of clean energy, once upon a time, when you looked at the revenue stack for a clean energy project, renewable energy certificates were an incredibly important part of getting that project and making it bankable so that you can go to the bank, ask for a loan, and that project could be built. But as the levelized cost of electricity has come down for solar and wind, we look at this all the time at Bloomberg NEF, the role of renewable energy certificates in some cases has been reduced. But for example, if I go to Japan, or I go to China, or I go to some of these other markets around the world where you can't sign power purchase agreements at a large scale, using a, for example, non-fossil certificate auction in Japan or tapping into China's renewable energy certificate market is an incredibly effective way for companies to go ahead and make those early investments in reducing their scope 2 emissions. And I think if you ask a lot of these companies, none of them are going to say this is the final strategy that they're going to use in order to achieve net zero, right? In a lot of ways, you can think of some of these commodities or these certificates as transition credits until you get more effective means of procuring clean power or carbon removals or some other type of environmental commodity at a larger scale. And so you've seen that with renewable energy certificates. You've kind of seen these shifts and changes in fundamentals in different markets around the world. And now you're starting to hear kind of companies talking about biodiversity, right? Because you're starting to see more regulation put in place around these things. So it was at BioCop last year. I love BioCop. It sounds like a sci-fi movie. It was at BioCop last year. I think it was in Montreal. They came out and they said, we need to catalyze and mobilize $1 trillion in 2030 alone towards biodiversity preservation. And biodiversity credit markets are going to play an absolutely massive role in doing that, right? And so all of a sudden now, you have regulators starting to think about this. That's step one. Now corporations are starting to make commitments, and the money's going to start flowing into these markets. And all of a sudden, you have a lot of biodiversity credit schemes that are popping up in different parts of the world. So a lot of these things are moving very quickly, and all of them will play a very effective role in corporate sustainability solutions. We speak to a lot of companies. If you try to shoehole a specific company, especially some of these sectors that have lower profit margins, into one means of decarbonization, and they can't afford it, it's not like they're just going to invest that in other means. They're going to reinvest that in their business. And a lot of times that's going to lead to more emissions. So the more tools we can give companies to reduce their emissions, the more impactful it's going to be for them to work towards net zero.
Far be it for me or for Vera to offer any sort of market predictions or let alone anything approaching investment advice. That said, I would make a few observations, which is that, of course, we do look at the policy signals that we're seeing, whether that's international or national, as well as, frankly, the growing interest that I think is out there. And I don't think that's going away anytime soon for the impacts that businesses and otherwise have. The impacts of not just their own activities, but their supply chains and so forth have more generally. And if you look at those sorts of fundamentals and so forth, if you look at the scale of the issue, whether that's and I'm not just talking about net zero, but I'm talking about circular economy or whether it's in biodiversity, nature challenges, the scale of that is going to require immediate action, and that's going to require lowest cost action, frankly. And we're seeing right now a rush from our point of view to find out those opportunities, to establish those relationships and so forth. Our sense is that regulation and tougher norms are coming, and in that sense, crediting, whether it's plastics or nature biodiversity certificates or carbon or whatever, is that way, is at that forefront there. And so I'll just offer that observation.
And maybe, sorry, just one more thing to add here. Even beyond when you think about renewable energy certificates, beyond the corporate angle, right, you have a thriving compliance renewable energy certificate market. There's 27 or 28 states now that have a renewable portfolio standard, and there's 18 that have a 100% renewable energy goal in the coming years, right? So those compliance certificate markets are going to be a huge driver of liquidity and trading activity in these markets. So it's not just corporations going out and meeting voluntary commitments. You have utilities that are under binding legal regulatory frameworks that will also need these certificates. So those are also a really important driver here.
Yeah, Kyle, I'm glad you touched on that too, because it really does come down to, sometimes compliance as the catalyst for wider adoption, and we did see that play out with renewable energy credits, as you mentioned, right? With renewable portfolio standards being introduced, certain states, implemented those policies. Other states, even today, still do not have those policies, but the broader marketplace saw that there's a unique and parallel interest when you develop a renewable energy project. We can mint RECs off the back of that in order for corporates and businesses to mitigate and perhaps, as Kyle mentioned, neutralize, right, their Scope 2 emissions and their footprint there. Staying on the topic of RECs for a second, right? So industry attention appears to be, and I say appears to be because I'd love to hear your thoughts and perhaps some questions and input from the audience towards the end, but industry attention appears to be accelerating for hourly RECs and 24/7 carbon-free energy. What is the role of renewable energy credits and hourly RECs compared to power purchase agreements, as an example? How do they compare? How do they contrast, complement each other perhaps, and maybe even how are they priced?
I can jump in on that. First, I'd like to second what Robin said. I'm not here to give investment advice.
Neither am I, just to be clear.
I'm pretty sure compliance told you that before you came here.
In fact, the views expressed here are my own and not the views of Morgan Stanley and Company or Morgan Stanley Capital Group or any of its affiliates. Anyway, so the hourly RECs, I think, are a really fascinating subject because to the point and to the subject earlier that we just touched on, I think if you look at the development of standards in these markets, we had, the guidelines that we settled on, the Green E guidelines or RE100 or VPPAs, just VPPAs themselves. There's an incredible opportunity actually for first movers to actually define those standards. There was nothing inevitable about VPPAs becoming, the kind of the prime product for a period of time. There's nothing fundamentally about that made it obvious, right? It was just people kind of taking that step and saying, I'm going to do this, and this is why I believe in it. And it got to a critical mass, and people kind of followed along, and now we're kind of moving on to the next thing. In terms of hourly RECs, I think it's a really interesting thing, because as we reach towards additionality in RECs, this is the problem, right? Like, renewable energy is effectively, if you just look at the levelized cost of energy, it's kind of economic, in a lot of places now. And so how do you go from, and so how do you deal with that, right? Unbundled RECs became kind of a little bit less additional, so then people moved to VPPAs. Hourly RECs, I think, really illustrates this conundrum or this problem and ultimately the opportunity. If you think of how a renewable facility gets developed, a utility scale renewable facility, let's say a 500 megawatt wind facility, right? It's not just a buyer and a seller, right? There's multiple parties involved. There's a utility region. There's a utility regulator. There's a grid operator, right? There's possibly municipalities involved, right? There's land use issues. There's environmental impact issues. And so the fact that a 500 megawatt wind facility comes up and actually reaches COD, I'm not trying to discount the impact of the power hedge and the REC hedge, because that is a pivotal thing, but that is two things on a list of 25 different things that have to go right in order for this to go forward. So the additionality claim on something like that is there's kind of an inevitability, right? If the ISO is approving of a project, it's because, or a utility region is approving of a project, it's because there's an implicit need for that additional power. The other thing about it, and this goes to the hourly issue, is when you build a 500 megawatt wind facility, you are implicitly having, the first thing that a regulator is looking at is whether or not there's enough fossil generation to support that incremental renewable generation. So if you just look at that one aspect of it, and again, it doesn't mean it's not worthwhile, it doesn't mean it's not adding renewable energy to the grid, but there is this kind of aspect of it, it's implicitly supporting fossil gen, because you need baseload generation from fossil generation in order to support a facility that size. Hourly RECs kind of illustrates this point, right? Because when you actually start to look at what you have to do to produce an around the clock, right, a baseload shape of renewable generation that matches something like fossil, you start to see the incredible value of certain certain ranges of hours during the day. And and that's because, that's because just right, the intermittency of solar and wind, right, it just kind of overlaps, and there's these pivot points, right? It's usually in the morning and the afternoons where it's just very scarce hours of renewable generation. So if instead of just buying the renewable shape and implicitly subsidizing fossil, what you're doing is you're actually compensating renewable energy for those scarce hours, right? That kind of flips it on its head, and it's just an interesting illustration of the point.
And I think the importance of, well, first of all, the importance of zero carbon or low carbon baseload generation. I mean, we saw the wildest example of this on Friday last week, right, with Microsoft basically rebooting 3 Mile Island to buy nuclear power for its data centers. And I think your description, exactly those certain points of the day, those certain hours where, for example, in California, if I just build a solar project and I'm adding more zero marginal cost solar in the middle of the day to that duck curve effect that we see in California, am I really having a huge impact on emissions displaced? Conversely, right, if I go ahead and I sign a wind PPA or solar PPA in PJM, that has a far greater impact, right? And you can apply very similar logic to parts of Europe and Asia Pacific. And so I think the value of a 24/7 or an hourly renewable energy certificate is incredibly powerful. To play devil's advocate a little bit, I'm a little worried though that we're putting the cart before the horse when it comes to the scale up of these hourly certificates. I think, for as mature as the renewable energy certificate market is, I still think we have a lot of work to do when it comes to clean energy buying for investors and for buyers and for all other stakeholders to feel more confident in the impact that they're having when they do this. There are a lot of corporations out there that have RE100 goals. I think there's now over 450, and many of them have made no progress on those goals because they have no means of doing so. And so they don't need hourly certificates just yet, right? What they need is to ensure that on an annual basis, they can ensure that when they're buying enough renewable energy and the amount of megawatt hours that are being certified through that renewable energy lines up with their electricity consumption on an annual basis. So I think there's just so much more development we have on that side, on the annual matching side of things. And I don't want to take away from what Microsoft and Google and all these other organizations are doing. They are trailblazers. They were trailblazers with PPAs many years ago. They're doing the exact same thing now with zero hourly carbon-free electricity. I applaud them for doing that. I think they need to continue to do that to open up access for other companies. But there's a huge gap, right, between where those companies are now and where the majority of other companies are. And so I still think there's a massive kind of lifeline out there, or a massive amount of more activity and more investment potential that we have for annual renewable energy certificates, concepts aside.
Yeah, all great points being made there too, and like you mentioned, certain businesses, and we can speak maybe to Google too, right? They're using these hourly renewable energy credits, and they're matching them with both industrial, but then also consumer load. Hence the Nest Greenleaf program, where you as a consumer can join that program and be matched up with RECs that are produced on an hourly basis. There's also this concept of emissionality, right? So beyond 24/7 carbon-free energy, there's this concept of emissionality. And Kyle and Juha, I'm just curious if you could speak to that a little bit.
I think it's as much as, it's certainly an interesting, it's a concept that makes a lot of sense, right? In terms of what the incremental benefit of renewable energy is per location, right? Because it's entirely dependent on how much the mix of fossil energy that's already on the grid at that time. But I kind of view it, to Kyle's point on the gap of development between annual matching and 24/7 RECs. That's a whole other, a state of evolution of data provision, of, if you just think about the complexity of that, like how do you calculate in terms of how interconnected the grid is, and imports and exports and all that, and how that evolves over time. If you have the scale of data that you need to actually accurately measure that, seems a bit further away. As an aspirational thing and as something that's sort of on the table for discussion as an issue to kind of progress towards, I think it's very important and very relevant, but probably a ways away from practical implementation.
Yeah, the media loves to pit emissionality versus 24/7. In reality, I think they're two sides of the same coin, and I think emissionality is, nothing more than a stepping stone towards hourly carbon-free electricity for the same reasons that you have just mentioned about emissionality is all about where can I ensure that I'm having the most decarbonization impact and displacing the most fossil fuel emissions by building a clean energy project. So instead of just building all my wind in ERCOT West, I can go and build it in other parts of the US grid where you have more fossil fuel penetration, for example. To me, that is a much more achievable goal for a lot of corporations than 24/7. But I don't see why it has to be either or, right? I think in reality, a lot of companies will start to incorporate emissionality into their strategies. So thinking less just about cost and more about impact. And I think that's a natural on-ramp for 24/7. So I think that's a really important part of this. And so at BNEF, we forecast clean electricity demand for all the RE100 members. And our latest forecast came out a couple of weeks ago. We think that the current group of RE100 members, with all their clean energy buying, all the activity that they're doing, they still need to purchase an additional 296 terawatt hours of clean electricity on an annual basis in 2030. That is a massive gap to goal, right? They're doing great work. They still have a long way to go. We shouldn't be pitting strategies against each other. We should be encouraging companies to adopt any of these strategies because they're all very effective.
Yeah, and great points there too. And switching gears back to plastics, right? Because we've talked a lot about renewable energy credits, 24/7. But those markets have had some time to mature, and we've learned a lot from that process, right? So, kind of a question, Robin, for you is just that evolution of RECs, that evolution of carbon markets. Is there anything there that can be applied to plastics credits and to help them become more widely adopted, perhaps impactful? Or rather, are there challenges that prevent wider adoption of these environmental commodities, and how can industry stakeholders address them?
Yeah, so I think good question. I think that there are some obvious parallels with carbon, and there are some areas where the pitfalls that affected carbon in its early years are less so. In the case of plastics, I mentioned earlier the concerns regarding additionality, the concerns regarding baseline setting. These seem to be lesser, but that being said, it's not as though plastics is immune from some of the challenges that faced carbon. Data, and I know we talked about this in the first panel, but I'll say it again. The voluntary carbon market is basically very similar to the CDM, which is a creature of the 1990s. And it's sort of an analog system for a digital age. And that's something that absolutely it needs to be changed. Verra itself is embarking on a very widespread digitalization program, which we hope will be helpful. And there are obviously, connections with registries and so on and so forth. But there are, that common data language is something that continues to sort of be absent. I think that's number one. I think number two is the issue of fragmentation. There are, of course, many different standards in the carbon space. Within plastics, there are fewer. But there are, the World Bank has recognized, three, I think, very called out three, one of which is Verra's, as being examples of those programs. But are those programs talking to each other? Are the credits fungible? I mean, there are all sorts of issues. Maybe we'll see the emergence of standardized contracts. But then, similar to with carbon, you can never quite escape the underlying project risk that attaches to the credits themselves. And I think it's an interesting thought piece as to whether or not it is possible to get to that next layer. How does that look without, subprime haunts us all, and how do we sort of avoid the creation of products where we're not just sort of transferring that problem? So I think that's sort of a nut that still needs to be cracked there. The other issue that I want to talk about in terms of challenges is really the one of ecosystem capacity. For any environmental market to work with rigor, it requires, frankly, an entire ecosystem of consultants, developers, third-party validators and verifiers, effective infrastructure providers, and so forth. All of this is something which is a challenge, which I think the business case is still being developed. From our vantage point, there are definitely opportunities for sort of really top-notch validators, verifiers to get into the game, and I think it'll be interesting to see what that could look like over the next few years. But there is that sort of that ecosystem capacity there. All that said, I don't want to sort of sound too pessimistic. Plastics has a lot of, from our view, advantages over carbon in the sense it's a tangible product, people see it, it's easier to quantify, frankly. No more baseline issues, it's sort of analogous to removals. So there's a lot of potential there, but I think that for various reasons, it's not quite taking off yet.
Yeah, I think cost is another factor, right? That's helping to benefit the plastic markets as well, right? You mentioned, Robin, that there's a lot of corporations that are going and making commitments to minimize their plastic waste, but replacing plastic with recycled products and minimizing kind of the use of virgin plastics is incredibly expensive for a lot of companies, right? And you've actually seen some corporations actually kind of ratchet down some of their commitments in this space because of the costs. You can buy plastic credits, right? And again, impact comes into play. There's a whole range of different types of plastic credits that exist out there. But in a lot of cases, you could buy a plastic credit for much cheaper now than what it would take to make those, to implement those efforts internally. So I think that is a big benefit to kind of boosting this market, at least in the interim.
Excellent points. Excellent points. So at this time, we'd certainly like to take any questions if there may be in the audience. We've got one right in the front here, please. I think we have a mic coming around. Yep. Thanks, Dylan.
Thank you. Test. Lenny Hochschild with Environmental Commodity Partners. Thank you all for your valuable investment advice, first of all. So, Kyle, you brought up, and thank you for bringing up the concept of the compliance markets being very large, right? Much larger than the voluntary markets. And to just kind of quantify that, and it's a plastics question, but to quantify that, the size of, call it the compliance markets, notionally via transactions are around $1 trillion. The voluntary markets are in the low billions today. So it's a question of scale. And with respect to plastics, although I think the consensus view is the voluntary markets are growing and will continue to grow, mostly driven by net zero targets. And so that probably scales up over the next number of years. Just to maybe help educate certainly myself and maybe the audience, are there plastic targets? How does one scale, number one, in the voluntary space? And then number two, do you envision there being any sort of compliance or regulated plastic markets in the years to come? Because I think from our experience, that's where you really are going to get scale.
Maybe I can just start there. So in the sense of plastics, and fully agreed. I mean, I think a lot of what the voluntary carbon market is, it's trying to position itself, it's creating those norms, the structure, the ecosystem capacity to make compliance decisions easier. And I think if one sort of takes the bigger picture, we tried the top-down approach with Kyoto, the idea that there would be a big policy signal and that alone would drive bottom-up action, and it didn't quite work. And I say this as a UNFCCC person, whereas Paris flips it on its head and says, well, actually, let's recognize bottom-up action. That will give policymakers the space and the comfort to be able to make the decisions that they need to for the benefit of the world. And so it's actually, I think when, in 50 years' time, when someone writes the history of this, I think it'll be interesting to compare the two approaches and which one worked, if either of them did. And if we're still around to read it. But the point that I want to make is that, yes, there is the UN Environmental Program is doing the plastic treaty. That is still ongoing to sort of what level of those targets those will be. We're also seeing a broadening out of EPR, extended producer responsibility schemes, around the world. India, Philippines are probably the most advanced. But there's more discussions that are coming. And broadly speaking, under EPR, there's going to be a fee charged for producers of plastics, and the possibility will exist, we hope and we think, that credits can be used in lieu of paying the fee. So very similar to a ETS or cap and trade in other places. But it's a little different, but that's sort of the basic premise. And so absolutely, you're right. And so I think part of what we're doing here at Verra is trying to sort of make that more possible, basically, by showing proof of concept crediting can work. We can drive finance, especially to the global south, such that these sorts of schemes can take hold and then hopefully ratchet up.
I'd like to take that a slightly different direction and completely agree that of the potential impact of a compliance market or a compliance-like market. But if we look at arguably the most, I think, kind of obviously the most successful environmental commodities market is RECs. And there is no compliance market for RECs. The sort of more meta point that I'm trying to touch on here is that there's kind of a debate in this market, rather than a live debate, is this a commodity? Is this really a commodity? Is it really commoditizable? And I think I stand squarely on the side of it is a commodity, not from the perspective of like it's going to fetch a single price, but that a commodity is something, as opposed to like a venture capital opportunity, right, or a technology or something. A commodity is something that has utility in and of itself, right? It's something that people need and something that people want because it's useful. And voluntary renewable energy credits, for whatever reason, are useful. They're useful. People perceive them as reliable and useful, not because somebody's telling them to do so. So that has a clearing price, right? That has a price that says, we're going to allocate a budget to this thing because when we buy them and when we retire them and we announce it to the world, we get credit for doing so. People perceive that as roughly we're offsetting our electricity usage. So I would argue that it's kind of a, we have to reach a tipping point of reliability of the product. And whether that is a compliance market coming in, or if it's the biggest plastics user in the world saying, we're just going to do this because we think it's a great thing to do, and we're going to just put it out there. This is what we do. This is how we are offsetting our plastic production by cleaning up the ocean's plastics. And we're going to spend money on it, and we're going to announce it, and we're going to get all these projects, and what kind of impact does that have? And of course, none of these things are independent of one another. Everything kind of has to row in the same direction. But I do think that there's a lot of, that there's maybe a little bit too much, when we focus too much on the compliance side, there's a little bit too much of a wait and see approach, I think. And that's actually not, in reality, how these markets have developed.
I think we have time for maybe one, possibly two questions. And if we don't get through all of them, everybody will be around for most of the day. So please save those for the balance of the day.
Can you hear me? Yeah. Christina Drivas at Elevate Renewables, and thank you for the very informative discussion. I had a question about battery energy storage. You mentioned earlier the importance of providing power in those morning ramp and evening ramps. And we see the impact that battery energy storage has had in ERCOT, in California, areas with strong renewable penetration, and now battery energy storage is, in many cases, displacing fossils in dispatch. Could you talk a little bit more about the role of battery energy storage and how corporates can incentivize the growth of this market, sort of mirroring how corporates have really impacted renewable development for VPPAs? Could we take?
Yeah, I would go back to the point of revealing the value of the most important hours in the renewable kind of production pattern, right? Because by revealing that allows batteries to address those hours. Because at the end of the day, renewables just can't do that, right? If solar is the single hump camel, I like to say, wind is the double hump camel if you're looking at 24-hour production, right? And then you have these inflection points that cannot be solved by renewables by definition. And so if you're in a 24/7 world and you progress to that and you start to reveal the incredible value, the scarcity of those hours, then that gives battery a target to come in and say, okay, I can provide relief of that price, right? I can kind of smooth that curve out.
I'll just add, so we did an analysis looking at how ready companies are for 24/7. And I mean, spoiler alert, none of them are ready. But we looked at kind of 5 main traits that were most important to being ready for that transition. By far, the most important trait is supply side flexibility. And energy storage is kind of the panacea to that, right? You can add zero carbon technologies like nuclear and geothermal and hydro, but storage will be the single most important point. So I think as there's more of a demand driver for 24/7 commitments and emissionality and hourly carbon-free generation, I think the value of energy storage will go up from the private sector. But right now, we don't see that as much of a driver because there's still companies trying to work out how do I just sign a 20-year bilateral solar or wind PPA, and that comes with that comes with downside as well. But that's just kind of where the private sector stands right now.
Do we have time for one more?
Thank you. I find this whole discussion interesting because you're saying the renewable energy certificates are basically the most, I don't know, it's a used environmental commodity globally, and they can also be used, I think, to demonstrate that a company which is buying them reducing its emission. Not reducing its emission, it's basically, it reduces the carbon footprint of this company. At the same time, carbon credits coming from renewable energy renewable energy projects are seen as non-highly integrated, not achieving the high integrity standards of ICVCM. How does this work together?
To be honest, I would ask the same question to you. I don't think there's anything, honestly, specific about why I don't think there's anything sort of inevitable or necessarily fact-based or objective about why the markets have developed this way. The arguments are valid on both sides, right? And we've just come to this point, and I think a lot of the questions that we have in the market in terms of like how we're going to evolve going forward, and why these questions are now coming to the renewable energy market now is because of this kind of convergence of exactly that kind of, I don't know, paradox that you're describing, right? And I think that's just the big question is how can we get that same view of reliability, again, to my earlier point, and this is maybe a nice little circular thing, but there's risk in all of this, right? There's risk in all of this, and for whatever reason, we have adopted and embedded and internalized and become comfortable with the risk, the additionality risk that renewable energy credits possess, right? That they implicitly have. And we haven't gotten to that point yet in the voluntary carbon space or the plastic credit space. And it's just all the people in the room here and everyone here this week is kind of trying to get to that point in time, because ultimately it's absolutely, obviously we need the first movers, we need the innovators, we need the people who are out there taking the, kind of defining the space now, but we also need to create space and comfort and reliability for people who don't necessarily have those resources that the Microsofts of the world have, right? To just be, to be able to access the market in an efficient way, and to know that they won't, that they're going to be procuring something valuable and of use. I don't know, that's not a very productive answer to your question, but that's kind of.
Can I add one thing really quickly?
Sure.
Sure, yeah, so I mean, I think the renewable energy, it's a surplus of renewable energy credits in the VCM market was a bug, not a feature. And I think the decision by ICVCM to make a lot of those methodologies ineligible, I think that is a really positive development in that market. I think the big difference between renewable energy certificates in REC markets and renewable energy carbon credits is the availability of alternative options. And I think, again, if I'm a corporate buyer that's trying to hit a RE100 goal or a renewable energy goal, RECs might be my only option to go ahead and do that, depending on where in the world I am. Or I can just go sign a PPA in Texas, and it's really not going to have as much of an impact. I think in the voluntary carbon market, if I'm not buying renewable energy carbon credits, which a lot of companies were doing just because they were dirt cheap, there's still a healthy supply of RED Plus credits, energy demand from clean cook stoves, and then there's the whole world of carbon removal that also exists. And so I think there's just more options that mean that we don't need to rely as much on renewable energy carbon credits in the same way that a corporation might rely on RECs.
Any final comments, Robin? Okay, very good. Well, I'd like to thank all of our panelists for their great contributions. Thank you all for joining us today, and have a great rest of the day ahead. Thanks.